the focus at the time was to try to find a way to give creditors who were initially at that time banks that then exchanged their debt for their claims for bonds, to give them the possibility to recoup some of what they had lost in the restructuring by sharing in the upside if Mexico outperformed its baseline projections. Historically, the BRIs were not very scientific. And I know because I wrote the formula for some of them and negotiated others. There was no real effort from a serious economic perspective to try to define trigger events that accurately reflected capacity to pay. There was no real effort to try to calibrate the payment adjustment mechanisms to capacity to pay. And you had basically a lot of horse trading where advisors and countries or issuers sought in essence to pay as little as possible. Creditors, on the other hand, sought to receive as much as possible. And you had a huge, so that on the one hand, Ukraine with value recovery rights that provided for what some consider windfall with, in some circumstances, no cap on the upside. And others, Greece and Mexico, where frankly the objective, which was relatively successful, was to limit the payments to the greatest extent possible. What value recovery rights can do, and in part, they really serve essentially two functions. One, which Melissa mentioned, is they can bridge the gap between baseline projections and what the IMF and the country consider to be a reasonable but no doubt conservative projection as to what the performance of the future will be, and what creditors think it might actually be. Or, for example, in the case, it's like the case of Suriname, where there's the strong prospect of serious upside from the potential from the production of oil, newly found oil reserves. The IMF does not take that into account in their DSA. So the baseline does not assume any upside. So it's quite reasonable on the part of creditors to say, well, if in 5 years these fields produce anything like what's anticipated, the country is going to be in much better economic shape, whereas the restructuring assumes that that doesn't happen. So we want to have the ability to accommodate our claims to the new reality. And you didn't get resistance really from Suriname on the basic principle. The second reason goes a little bit beyond that, and that is simply an effort on the part of creditors to say, look, if things get worse, we need to make sure that we're not stuck with payment obligations that we're not going to be able to perform, because if things turn for the worse, there's no automatic adjustment mechanism. And the only thing you can do is default or go back to the creditors and say, sorry, we need to restructure again. And similarly, I think there's some realistic expectation that if things get much better, why not? I mean, it's not entirely a zero sum game. So historically, these instruments were not, frankly, particularly well designed. There were serious issues in valuation. The market was unfamiliar with them. They had very little liquidity, and they traded at very low prices, in some cases justifiably so, in other cases not. But there was no consensus on what the value of these instruments should be. All these instruments, and I'm now talking about BRIs, there are other state contingent debt instruments, of course, that are not calibrated for the purpose of measuring capacity to pay. But I think in this context and for this purpose of the paper, which I'll say a few words about at the very end, we're focusing on the use of these instruments in a restructuring context. These instruments, again, historically were upside only. There was no downside reference. And for the most part, they had periodic adjustments. So unlike Zambia in their current restructuring, where you look at one point in time in the future, and if the IMF makes a determination that their capacity to service debt has increased from low to medium, there's a one-time adjustment. In Mexico, Venezuela, a number of other countries, we looked at GDP or oil prices or the like, you recalibrate it every year. And so it was quite different. There are advantages and disadvantages to that, which we can talk about in a minute. So what are the issues today as more and more countries and creditors are saying, for their own reasons, we want these instruments, but we need to have better designed instruments. And they're right, we do need better designed instruments. So let me just quickly run through the issues by identifying them. We don't have time now to go into them in detail, but first question, of course, is the definition of the event. What is the state contingency, which will automatically result in a change in payment terms? You want, to the extent possible, for that contingency to be aligned with capacity to pay. That's not easy. And the efforts, if you look at the efforts in the past and some of the efforts today, you'll see that there are big differences. In the past, for example, we looked at GDP, we looked at oil revenues, but GDP, every dollar of GDP does not result in an extra dollar of payment capacity for the country. To the extent it's private sector, the government share comes from taxes. And if you look at oil revenues, yes, that's money coming in, but they're also expenses. So oil revenues could be 100, but the actual net of expenses could be 50, 70, 10, it all depends. So for example, if you look at the BRI that's been negotiated for Suriname, it deals with that issue because what they focus on are royalty payments to the government from fields that are exploited by someone else. So you don't have, from the government's perspective, it's not a question of revenues less costs. The revenues are net. They receive a royalty, there's no offsetting cost. It's a much better calibrated measurement of capacity to pay than just looking at oil revenues or just looking at GDP itself. You also have to look then at the adjustment mechanism. If there's a trigger, what happens to the payments? What portion of the excess revenues that the government will receive should be distributed to creditors? What portion should be fed to the government? There are questions of incentives. There are questions of fairness. There are questions of how you measure these things. It's a big issue. Similarly, as I said just a minute ago, do you look at a one-time test, as is the case in Zambia, or do you look at a test that's done periodically? Could be annually, could be every 3, 4, or 5 years, and you'll have different results. The risk, for example, in Zambia is, and the date that the test is that the measurement is made, the country might be doing much, much better. But a year or two later, they might be doing much worse, and there's no mechanism to reduce the payments to reflect what's going forward. The same is true in Ukraine, where you may have an event that triggers additional payments, but when the payments are actually due, the capacity to pay may not reflect what was actually behind the initial trigger in the first place. Do you have a single test or a multiple test? Do you just look at one variable? Or as in the case of Mexico, do you look in two variables, one related to oil prices, one related to volume? Perhaps in some cases, by looking at more than one test, you have a more accurate representation of capacity to pay, but you also have an instrument that is harder to value. And because it's harder to value, the liquidity may go down. And there are also issues, which I'll come to in a minute, of eligibility for inclusion in emerging market bond indices, which are another, another element of liquidity and indeed of value for the bonds. So those, I think those are the main issues, and there are trade-offs between them. For example, if the value recovery instrument is a standalone instrument, separate from the bond that actually restructured the debt, you can only have a one-rate adjustment. There's no way, because it's just an instrument provides, it's like a warrant, and provides for additional payment. But you can't reduce payments because the payment is zero unless there's an upward, excuse me, an upward adjustment. So you can resolve that either by embedding the value recovery instrument in the bond itself, which is something creditors fought against in the very beginning in the case of Mexico, and which also might impair the eligibility or index inclusion of the bond itself. So you can have a binary choice, separate or embedded, or you can be more creative and say, well, we'll split the bond into two parts. We'll have a bond with the majority of the amounts that are payable, which will be a plain vanilla bond, doesn't adjust one way or the other. We'll have another bond with a much smaller amount, which can accommodate adjustments up or down. And even if that bond is not eligible for inclusion in the index, at least the main body of the restructured debt will be unimpaired. So you have that trade-off. You have trade-offs between simplicity, which I think, and standardization, which are, I think, desirable, as was done with the case of CACs ultimately. I think these instruments will trade better in the market, will have better acceptability if there's some standardization and simplicity. But standardization and simplicity are not maybe in tension with trying to devise mechanisms for better measurement of trigger events, better measurement of payment adjustments. One might call for a one-time adjustment with a single variable. One might call for multiple adjustments periodically with multiple variables. There's another issue with index eligibility, which is not necessarily or not a function of value recovery instruments that you can deal with a priori, and that is that the primary index creator is JP Morgan. They, to date at least, have been unwilling to say in advance whether an instrument will be eligible or not. You can give them all the terms. They'll say, we'll issue it and then we'll tell you. That doesn't work very well. Or they will say, well, look at our rules, but the rules are ambiguous and different people will react differently. So that some say, well, if you have any downward adjustment, then that's incompatible with index eligibility. I don't think that's right because you have GDP-linked instruments, or inflation-linked instruments, which are in indices, which go up and down. Others say, well, if you go down to zero, then you have no principal, so that's clearly not eligible. Well, that's easy to fix, put a floor. So there's an element of uncertainty that it's hard to deal with for those who are trying to create the instrument in the absence of any way to determine with certainty how the instruments will be treated. There are two other subsets of issues that are important I'll just mention. One is having a value recovery instrument complicates an already complicated issue of comparability of treatment. If not all creditors receive the same value recovery adjustment, then how do you determine comparability of treatment? The official side, for example, the official creditors say, well, we will take, of course, an upward adjustment, and in some cases they insist on it, but under no circumstances will we have a downward adjustment. So if you have bondholders or private creditors with an instrument that provides for upward and downward adjustments, and official creditors only with an upward adjustment, how do you assess comparability? Well, the baseline treatment may be different, but there's no accepted way of trying to, at the moment at least, of how to reconcile those two. Similarly, from the IMF's determination of the DSA, what weight is given to payments under a value recovery instrument. Today, what the IMF does is they do, in effect, a statistical examination, the so-called fan chart, and they look at what they assess will be the likely. They can't measure and determine a DSA under multiple or infinite number of situations, but they look at what's likely, and they then make a determination. But they don't take some things into account. As I said earlier, future improvements, say in the natural resource field, is not taken into account. They assume, absent evidence to the contrary, that every creditor, including those that don't have a deal at the moment, but may have a deal subsequently, this could be official creditors, they assume that every creditor will get the same upside adjustment. So even if you make a deal with one group of creditors, but not with the others, the IMF will say in our determination of the GSA, absent evidence that or an agreement by the creditors who don't have that feature, that they're going to get it or insist on it at a later date. So those are the basic issues. I think an effort is being made, and the roundtable is probably a good beginning place to try to deal with some of these issues, particularly simplicity, standardization, and definition of trigger events, knowing that by its nature, different countries are going to have different requirements, different trigger events, and different formula.
Thank you, Mark. No, it was a really interesting paper with a really thoughtful layout of the issues and considerations. So just in terms of format, I'm just going to ask a quick question, then I'll open the floor for any other questions. And then in terms of efficiency, just ask you to perhaps address all the questions at one time. I think we have about 3 minutes for questions. So if you do have anything, get it ready and be prepared. So my question is just obviously all the papers that we're going to discuss today talk about the relative little modern use of SCDIs, but the conclusions differ in terms of whether or not they're useful. If you could name one reason why SCDIs have not really taken off, particularly outside of the restructuring context, what would that be? And then I'll ask any other questions from the room.
Hi, my name is Chayo. I'm from a macro firm based in Sri Lanka. So very great, I think, foundation for the discussion. A lot of the points that you mentioned on the dual tests, multiple tests, whether it continues or not, are factors that are currently being discussed in Sri Lanka's own macro-linked bond proposals. I have my views on what can go wrong. Others can have other views as well. But my question is that for countries like Sri Lanka, emerging foreign frontier markets, who issued their bonds in the pre-COVID liquidity phase, these current restructurings would be happening into a context where whatever restructured payments would likely come due in a context where global liquidity is likely, all things considered, to be tighter than it was in the past. So refinancing of anything in the future is likely to happen in a context where liquidity conditions for these markets are probably tighter than they were when the bonds were originally issued. So my question is a little macabre in a sense that even if the state contingency itself does not necessarily include as much of a downward adjustment for the issuer's benefit, whether the fact that you'll have to refinance them in a tighter liquidity condition results in a context where there's some amount of default risk into the future that in a way perhaps doesn't get priced in at this point, but might be considered part of the future pathways for what these for the outcomes can be.
Hi, Mark. Ben Heller from HBK. Quick question on this. SCDIs are meant to deal with uncertainty, but it seems like there are two very specific different kinds of uncertainty that might need to be handled differently. First is real uncertainty, like what is going to happen. Just the kinds of uncertainty that SCDI is supposed to deal with. So there's a real uncertainty, how the country will evolve, or things like whether oil is produced in Sri Lanka. But I think the bigger reason that people are using them in restructurings is model uncertainty. The IMF has its model. We have our model. We maybe both believe that our models will accurately capture what's going to happen in the country, but the models are different. And the way that we're bridging that gap is through an SCDI. So is that an appropriate use of SCDI, and would you design them differently to deal with that uncertainty?
2 minutes.
I don't have a definitive answer as to why SCDIs have not taken off. Sorry, in the non-restructuring context. I mean, we're kind of moving there in a sense. I mean, the climate resilient debt clauses are an example of use of new money now being adopted by certain development banks as well, variable instruments. But I think there's a certain attractiveness to plain vanilla bonds, and they're easier to market for sure. and there's no experience really in issuing these things. And I think it may happen. It may happen, but I think it's, you don't, I mean, the example we were just talking about model uncertainty and so forth, doesn't really arise. And so people price it, and you always have credit uncertainty with any issuer. So that's not unique to sovereigns, right? So as to the question from the gentleman from Sri Lanka, it's an interesting observation that do you take into account in the design or pricing or valuation of a state contingent debt instrument the fact that as a result of tightening market conditions, refinancing risk is higher and you may have to pay a larger premium to refinance? I think the answer is nobody's going to do that because it's too complicated. It's too hard to try to value that. And besides, you don't, I mean, if the bond is going to be refinanced in 5 years or 10 years or 15 years, no one's going to try to figure out now what the market conditions are going to be that far in the future. So I can see the attractiveness of trying to do that, but I think it's too uncertain. And I think there are already valuation issues that are a huge challenge to begin with, without trying to predict market conditions years into the future.
Vicky, I'll give you 30 seconds to answer the last question.
30 seconds. As to model differentiation in models, yeah, absolutely. I think that's another iteration of what Melissa said of different expectations of what the baseline case is, and trying and using a value recovery instrument or state contingent debt instrument as a way to bridge the gap in expectations. It's not perfect, obviously, because you start with the IMF model almost by definition, but and you're not going to recoup. Well, you can recoup. So I think yes, the answer, the short answer is yes. I think that is in fact being done, and it's a legitimate reason.
Thank you so much, Mark. Thanks. Okay, I think we're going to go back in time now a little bit with Gonçalo Pina, a professor of international economics at ESCP Business School in the Berlin campus, is going to present his paper on the state contingent debt premium evidence from French public bonds in the 1950s.
Thank you very much. Okay, good morning, everybody. Thanks to the organizers for having the paper in the program. What I'm going to be talking today is about an experience with state contingent debt instruments from the 1950s in France, and a very interesting experience which allows us actually to calculate one of the crucial elements in this kind of instruments, which is how costly are they for issuers? What is a state contingent debt premium? Okay, so very good. So you know, state contingent debt instruments are issued, have been issued in some instances. You know, they might be connected to commodity prices, to GDP, but you know, they're frequently issued part of debt restructurings or by developing economies, which is sometimes they're issued too late to be useful, but they're also issued in other contexts, and so those contexts tend to be, you know, small issuances, very liquid, hard to price, the view that they might be too little. So, you know, why don't we see more state contingent debt? Well, one of the answers, the common view, I think that, yeah, but it's not a full screen. Maybe you can, yeah, sorry. One view is that it's too costly compared to traditional debt. So we don't issue because you're going to have to compensate investors too much. These fluctuations in payments are too expensive, so we're going to have to compensate and give them higher yields. Now we went too much, sorry. Okay. Now, it is difficult to estimate what is the real state contingent debt premium using current observations of state contingent debt because they are too little, too late. So what we need to do that, what would you like to have is a perfect, what would be the perfect experiment to do this exercise? Well, we would like to have debt, state contingent debt that is issued in normal times, that is relatively large and tradable, that we can price, and that for which we have a good control. That is another bond, which has very similar characteristics in terms of maturity, tax treatment, you know, every liquidity, everything except the fact that one is traditional and the other one is state contingent. Okay. Now, to find this is very difficult, but there is one example, and that example is the main contribution of this paper, which is French bonds from the 1956, where in a period of 1 month, with a distance of 1 month, the French Treasury issued one traditional bond, and then 1 month later, a state-contingent debt instrument, which was linked with coupons linked to industrial production, the level of industrial production. And what we do here in this paper, which I forgot to mention, is joint work with Kris Mitchener, because I didn't see my first slide, is estimate yields to maturity for these two assets, and then extract from these the state contingent debt premium. What we find is that at issuance, the expected state contingent debt premium, expected because we don't know the future values of industrial production, is about 116 basis points. Okay, this is in line with a lot of work that has been used models to estimate the state contingent debt premium, theoretical models, not necessarily this kind of simple empirical computation I'm doing here. The realized state contingent debt premium is larger. Okay, so the French economy grew more than expected. So the realized state contingent debt premium at issuance is almost 200 basis points, which maybe makes it a bit expensive. But the other thing we find that is very interesting is that after a few years, these bonds were tradable in secondary markets, so you could buy them in secondary markets, and you can extract the yields implied by secondary markets, until the bond matures. And after some years, the state contingent debt premium was zero, both in terms of realized state contingent debt premium and expected, which really raises the question: okay, is it too expensive or not? At least for this specific framework, for this specific bond, maybe it isn't, and that's what I'm trying to show you today. So what is the bond? This is the bond, okay? So it's a bond to invest in, I'm not going to try my French there, but it's the crucial part is that it's a 5% coupon plus this majoration, which is the variable part, and will depend on this on the level of industrial production relative to a base year. Okay, so it's not a growth bond necessarily. It's more about the state of the economy, in this case, industrial production. Industrial production in France at the time was about 30% of GDP. So this can be thought as a very early example of a GDP-linked bond. Now, the second contribution of the paper is to actually, let's see if it comes back. It's actually to, introduce these bonds and make them familiar to everybody, because they're not very well known. So if you read Schiller 1993, where he's talking about the existence of national income markets, he says they don't exist. And the closest that they could find is some options, some swaps on business cycle variables, but nothing like a bond that pays more when the economy is doing well and pays relatively less when the economy is doing not so well. But if you read the finance minister of France in 1956, that's exactly what he has in mind when he talks about this bond. So here to Le Monde, he talks about owners of this bond as shareholders whose dividends vary according to national income. This was not just in France, okay? So there's an interview with the New York Times in June 1956, where he talks about the interest payments on this bond as a dividend that change with national product in France. That's exactly what Schiller is talking about in 1993, but it was kind of forgotten in the intellectual history. So that's one contribution of this paper. Now, this bond is particularly interesting. It's a GDP-linked bond in terms of industrial production, but it's not the only one in France at the time. There are many more bonds that have this kind of characteristics. So what we're working on with my co-author is actually look at these other more complicated state contingent public bonds and also private bonds that were state contingent. We had things like a bond that paid more depending on the price of electricity issued by the electricity company in France at the time, or a car company that had a bond that paid more depending on revenues. Okay, so so there's a very interesting, very interesting experience to learn about from French experience at the time. Okay, so quickly historical context. So this is a period of high political instability, of wars, but it's also a period of economic growth. So it's called, there's catch-up growth after World War II. There's the Marshall Plan. There's something that's going to be important for this paper, which is indicative planning. So the government would announce some forecasts for the future, which we're going to use in our analysis. So the government had issued a gold index bond in 1952, but then in 1956, 1957, they issued 3 bonds. They're relatively large, okay? So the bond I'm going to be focusing on is the bonds AIA. They're about 20% of public debt in 1956, which is sizable. Later that year, there's another state contingent debt bond, which is a bit more complicated, which was 75% of government bonds. And the next year, we have another one, which is 75%. So, this indexation was very normal in France at the time, both from the private sector and the public sector. So we kind of can expect, at least there was some idea how to price these things. Then eventually it was made illegal with the Fifth Republic, okay, 1958, no more index debt until the 70s. So kind of here a small experiments to experimental station to learn about state contingent debts in the wild. So we obtain data from official sources. There's a very nice database for financial history in France, which I recommend to anybody interested with the DFIH, where you can get price data for these bonds. And let me just show you how they look like. So these are the two bonds we're going to look at. So on the left, we have the bonds PTT. Those are the traditional bonds. On the right, we have the bonds equipment. Those are the state contingent bonds. And they are very similar. So if you read the text, the legal text published in the official journal, they're very similar. The text is very similar indeed. And what do they share? Well, they are treasury securities. They have 15-year maturity. They pay an annual coupon. Reimbursement is made using a lottery. Okay, so every year they draw some numbers, and then if you get those numbers in your bond, then you get the money back. You get the face value back. There's no taxation of interest. They're issued the same places with the same face value, and they are tradable in secondary markets. So they're very similar bonds. There are some differences. What are the differences? Well, the bonds PTT, the traditional bond, is issued a little bit earlier. It's a little bit smaller. Okay, so it's about 5% of public debt in 1956, and it has a fixed interest rate of 5.5%. That's the coupon. So that's a traditional bond. And then the state contingent bond is issued a little 1 month later, pays 1 month later. We can account for that, and has a fixed interest rate of 5%. And this is the contingent part plus 5%, the difference between industrial production from the previous year and the baseline. Okay, the amount issued is a little bit larger. So other than that, they're more or less the same. So it's not a perfect comparison, but it's quasi twin bond strategy. And these are the bond prices. Okay, and you can see they're issued with face value of 100. So this is a subscription-based model. It's not an auction. So the government says, if you pay me 100, you can get one of these bonds. And so they're issued around this time. Okay, and you can see that for most of the time, in the beginning, the prices are more or less the same between the bonds, traditional bonds, which is the gray one, and the state contingent bond, which is the black one. But eventually, the French economy starts to do better than expected. And the bonds that are indexed to industrial production, the price goes up a lot. Okay, so they're very fashionable bonds. People will start buying these bonds. But this, in turn, will mean that this will reduce the implied yield. Okay, and that's kind of what we are doing then. So we have these bond prices throughout time. The other thing that I'm going to mention before, in case I run out of time, notice what happens here. So that's the state contingent bond in 1968. The price collapses. What happened in 68 in France? General strike. We have a recession. So that's kind of the contingency starting to work there as well. Sorry. So what are we going to do? We're going to compute realized yields. Realized meaning what? Realized industrial production values. But we're also going to do an exercise for expected yields. Expectation in which sense? Expected industrial production. Okay. So the exercise is very simple. So here we have in dark the realized industrial production index. So it's growing over time. The dashed line is a forecast that was published in the New York Times. So we don't have very good forecasting data. We're going to try to be creative, try to find some data. So I'm going to use this New York Times forecast about what these bonds are expected to pay and use that to compute the expected yield at issuance. This is the article in question. At the bottom, you can see in the French economy keeps growing at the rate expected by official economic thinking. That's our forecast. We have a return of 8.65% or 11% in their 11th year. How much time do I have?
2 minutes.
So here we have so what we're going to do for the time varying forecasts, we're going to use the French planning. French planning means that the government would announce a plan for industrial production and the forecast for industrial production at multiple times. And here we have the third plan, which the dashed line compared to the realized industrial production, the fourth plan, the fifth plan. You can see they're kind of close to what is realized, but you can see the contingencies in action here. So in the fifth plan, we expect this, but nobody expected May 68. Nobody expected in the general strike. Okay, so there's some challenges to compute the yield to maturities, but nothing crazy. So we have the redemption lottery. We have the fact that we don't know the state contingent debt cash flows, but we can approximate them with the realized or the expected. And there's this 1 month difference that we can correct for. That's easy. So just to remind you before I show the results, there's a traditional bond. If it's redeemed, it pays the coupon. If it's not redeemed, it pays the coupon. If it's these are swap. If it's not redeemed, then you just get. If it's redeemed, you get the coupon and the face value. And then the other one has this state contingent part depending on industrial production. Okay. So they're I'm going to skip this part. So I'm just going to show you the yields to maturity. So here the dark is the state contingent debt. The gray is the traditional bond, and you can see that at the issuance, the yield to maturity are much larger. This difference here is going to be the state contingent debt premium, but you can see that this difference starts to go down with time, and eventually it's zero. And then it increases again after the shock of May 68. So I can compute the difference between these yields to maturity. That's my state contingent debt premium. And you can see it's relatively large at first, goes down with time. Eventually, it's close to zero. Okay, it's even negative. We have some noise in these measurements, but on average, it goes close to zero by 63, and eventually negative in 65. But then with May 68, it goes up immediately. So this tells us a little bit that the state contingent debt premium might be dependent on the state of the economy. And at issuance, we cannot trust this too much because it's a subscription method. Maybe they overpaid. If it was an auction, maybe they would pay less. But it's still high for a while. In good times, it's low, and then in bad times, it increases again. So this tells you something about when to issue. That perhaps it's better to issue in good times, in the normal times. The state contingent debt premium might be less than you think. And that's basically the final thing I want to show you that was realized. Okay, those were realized, the contingent, the ones I showed you before. Now I can do the same with expected using the forecasts by the French government. And I can do this for different waves. So I have at issuance, the New York Times projection, I get 116 basis points. But then the third plan is already 20 basis points. Then negative by the fourth plan. And then the fifth plan, 30 basis points or 95 basis points for over 5-year horizon. That's much less that's been considered in literature. And so that kind of suggests that an expectation, these French investors were not asking for too much compensation for holding this debt. Okay, and I'll conclude with this. Let me just 30 seconds just to show you May 68. Okay, so this is the forecast in 65. So expect this growth in industrial production. And then here we have May 68 where industrial production is lower than expected. So this is contingencies in action. So this can be a useful bond. This very simple bond can still be useful for shocks like 1968. What is interesting though is that price of the bond goes down dramatically as you would expect because industrial production is low. But then we only have a few years afterwards, but the premium stays elevated until the end. There's some state dependency there of the premium. I think that's the main message I want to give today. Very good. Thanks very much. And I'll find that.
Thank you. Terrific. Super interesting. I mean, I think this is, one of the things I found interesting about it is obviously you see the instrument through to the end. So my question to you is, how do you judge whether an SCDI has actually been a success or a failure? And what would you say about the French bond? And now I'll open it up for questions from the audience.
Thanks. That was absolutely fascinating. I was on the Bank of England committee to draft the London term sheet for the GDP-linked bond, which actually has a very similar formula, a simple formula, basically based on inflation-linked bonds, but very difficult to explain to anyone that was actually more simple than they thought. And there were two issues with that. Number one, Mark mentioned the index inclusion issue. It just completely wipes out most of the market when you can't tell whether or not a bond, if issued, would be in the index. But the second thing, which was really frustrating, was the IMF guidance to DMOs, which is, I think it still is, I don't think they've changed it much, to find the cheapest financing. So even with your analysis, which I absolutely find fascinating and really it would have been really useful back when we were doing this about 10 years ago or 15 years ago, even at 100 basis or 116 basis point, differential would mean for your DMO, oh, it's still too expensive. We don't want to go that route. So, I mean, I guess we don't have more examples because this to me is a unique set of bit of research. So how do we get the DMO? How do we get the IMF to say, look in the round, at how these could help you manage your debt over time and make it more sustainable over time. Anyway, that was just fascinating. If we had that back then, I think that it could have helped the case. So congratulations, it's really interesting.
Okay, so I don't have the answer to both questions. I think, but I have some thoughts, and I think there's a lot of discussion to have about this. But I think that what this kind of shows you is that maybe the place to start with new financial instruments is not countries in distress. That maybe, to establish the instrument, to establish the market, you have to go to the developed markets with good institutions where there's no fear of statistical manipulation, where a simple formula will suffice. And I think that's the main lesson. So it worked in France in 1950s. It was eventually, was successful, eventually was canceled. So, I mean, it was illegal, made illegal. So I'm not sure how much of a success that was, but, it attracted savings, 20% of savings, of 20% of public debt. So it was large, but it kind of shows you where to issue. And if you want to establish a new market, which could be useful, we know from theory that there's a potential to be issued as long as the costs are low, as long as the premium is low, as long as the state-contingent debt premium is close to the 30 basis points that I show you, in 63, but not the 120, then there's a potential for the market to exist. Now, with climate bonds, we're doing this. So Germany issues the green bonds to get the greenium. That's how we should do it. We should do it in Germany, we should do it in France. And then if it works there, then we can use it and can be very useful for countries that might find themselves in distress, like developed economies may find themselves, like the French economy found itself in May 68. Okay? So I think that's the main lesson, to build a market with the best possible conditions, test it there. If it works there, then it will work in other countries, and that will make an improvement in sovereign debt markets.
Oh, one other question real quick.
Yes. Why was it illegal? So, so the question is, why was it illegal in 1958? So there's the Charles de Gaulle comes back, Fifth Republic is instituted, and one of the things that caused this was high inflation. So one of the reasons why the Fourth Republic was abolished and we got the Fifth Republic is very high inflation in France. Now, most of these bonds, so the original 52 bond was linked to gold, and it was precisely because there was high inflation. It was linked to gold to encourage people to buy this bond. Don't worry about inflation. So the blanket cancellation of these bonds in 1958 was mostly targeted to these nominal bonds. This is not a nominal bond, it's a real bond. It's a bond that depends on industrial production. But it was canceled with it. So that's the reason. The reason was inflation. Now in 1956, inflation was low. But then with Algerian War and a lot of things happening in France at the time, in 1957, 1958, inflation increased. That led to a cancellation of all index contracts. And that's the reason why we stopped seeing them. So I would say it was by chance. This market was eventually destroyed before it was allowed to be in place. Yeah.
Great. Thank you so much, Gonçalo.
Thank you.
So moving forward to the modern day times and current growth index bonds, Julien Acalin, an economist at the research department of the IMF. He's obtained his PhD in economics from Johns Hopkins University in 2023, and his research focuses on the role of global banks in the global financial cycle, the history of U.S. public debt, and potential benefits of growth indexed bonds. Julien.
Thank you. Thank you, everyone. So my name is Julien Acalin. I'm with the IMF. So what I'm going to show you today is my views only. The usual disclaimer applies. So I'm going to talk about GDP-linked bonds, more specifically, and their impact on the debt distribution. So many of you may be aware with the DSA, the stochastic DSA, and with GDP-linked bonds. And so what I want to see in this presentation is whether the introduction of GDP-linked bonds will help reduce the probability of reaching very high debt to GDP ratios. So whether it will shrink the support for the debt to GDP distribution going forward. Hopefully I get the slides. Okay, so the type of this is not moving. Okay. Can you? Okay. Good. Still. Okay, great. So the motivation for the paper here is that we had the recent surges in debt to GDP ratios. So here throughout the presentation, I'm going to talk about, I'm going to focus on the case of Spain. And so as you can see on this chart, so I'm showing you the dotted line is the debt to GDP ratio in Spain from the 2000 until today. The shaded areas are the recessions. And so as you can see during the recessions, we had the global financial crisis, then we had the euro area crisis in Europe. So the debt to GDP ratio spiked in Spain. And then later with COVID, it spiked again. So of course, this increase in the debt to GDP ratio happened during a time of a recession. So that's the blue line. You know, when GDP drops, when R minus G becomes positive, then the debt to GDP ratio is increasing. But not only that, during these times, you also have drops in the primary balance. So what happens in recessions is that the primary balance is going to turn negative because fiscal policy is counter-cyclical, and that further increases the debt to GDP ratio. And so the idea, the basic idea of GDP-linked bonds is that if you can link interest rates, which is the red line here, to the GDP, the blue line, you reduce the volatility in the debt to GDP ratio. So in this presentation, I'm going to focus on the very simple type of index security. This is going to be a gross index bond, and the formula is going to be extremely simple. So here the coupon I is simply going to be equal to the growth rate of the economy
as you increase, if you increase the coupon, you increase net present value. That's the relationship. Value. If you reduce the discount rate, you keep clicking, you can get the same net present value with a lower coupon. Okay, that's simple. So if the KPI is, which means just keep clicking through and tell you. So it creates a Pareto improving space in that colored space. That colored space is where net present value goes up, but coupon comes down somewhere between C1 and C2, and net present value goes up between N1 and N2. So this is the unique feature of this bond, because it's inbuilt into the bond that there's a benefit to the bondholder and a benefit to the country, not other in a standard sustainability linked bond. The benefit is to a global public good for which somebody must pay or somebody must take the risk in order to enable it. But this bond is intrinsically in itself actually creating an incentive for risk reduction, and then bondholders are offering to share with the country the benefit of that risk reduction in a way that is Pareto improving, that is both parties can be better off without making the other worse off. My colleague and co-author Rajakulendran will actually just run through a numerical example, because we have different types of people in the audience, and just to run through an example too.
Thank you, Nishan. The same slide, but if you move forward, what we're trying to do is we've set out the framework, and what we're saying is now, shall we just put numbers in and see how it works? The next slide. Yeah, so this is the basic features of a synthetic bond. Let's say there's a face value of 1,000 and it's going for 10 years. And the governance assessment is on the 4th year. The 4th year is based on a regular IMF program, goes for a duration of 4 years. Initially, the coupon is 6%. And our assumption, like Nishan said, is that as you start, as you issue the bond, the risk of the bond is at around 8%. So that's your discount factor. And as you meet your governance commitments and your governance conditions, the risk reduces. So you put a lower discount factor of 6%. And how does that play out? If you go to the next slide, it's simple net present value calculations. This basically tells you that, hey, you have your bonds, you have your cash flows, I can do a net present value. I get 858, that is scenario 1. And then there's scenario 2 where the governance criteria is met. And that's what you see in the bold, where the discount factor reduces after year 5, because the test is done in year 4. I mean, the paper dwells on the mathematics. You discount it again back at 8% and 6%, but I'll let you read that. But what you see is that if you don't meet governance commitments, you operate as a plain vanilla bond. You get your same coupons at 6%, you have your same risk at 8%, and you get 858 in this example. Now, if governance does improve, you get 933, which is an additional price increase because governance has fallen. And if you go to the next slide, just to summarize again what Nishan was highlighting, at 6% was your base case. You had 866, but then the risk reduces, which means you have an NPV of 934. And our synthetic example basically said that, hey, you can go for a coupon reduction of up to 4%. So let's meet in the middle and let's say 5%, where the country also has a reduction in the coupon from 6 to 5, and the bondholders also benefit from slightly increased net present value. So that is the synthetic example, but let me summarize it all in the next slide. Yeah, so basically you start off with a base case and you have your bond prices at 866. Governance criteria, previous slide. The governance criteria is not met, and then that means it's just a plain vanilla bond. There is nothing new about it. If the governance criteria is not met, you get your 866 as your NPV. But if your governance conditions are met, you have two options. You have a no coupon step up, step down, and you go to 934. But what we're suggesting is you go for a coupon step down, not to the maximum, but somewhere low at 5%, where you get an NPV of 898. So in this model, or in this synthetic example, the government benefits by paying 1 percentage point lower coupon. The bondholder benefits slightly because he's getting a higher net present value than he would if it was a plain vanilla bond. So it's a win-win. And the worst case scenario is that you end up with a plain vanilla bond. The best case scenario is the country's governance improves and also bondholders benefit. And there's a financial incentive linked to it. But I'll give it back to Nishan for the free rider problem.
Thank you. So actually, the free rider problem is going to be a question you ask me later, and I will answer. I'm going to move beyond that, or outside of that, to just quickly say what's a negotiation look like and what are the dynamics of a negotiation on this kind of bond. That's the pricing for a plain vanilla bond. We'll call it P1. The next slide shows you that when you introduce this bond, the worst case scenario is it becomes a plain vanilla bond. In state one, the country doesn't achieve its KPIs, but the best case scenario is that it achieves the KPIs, and if it does it with certainty, it gets P2, a much higher price. But in reality, there's a probability attached to whether you will achieve these KPIs or not. So we'll call that alpha. And so the actual price in the market of the governance linked bond is going to be 1 minus alpha P1, alpha P2, and where alpha is the probability that the governance criteria achieved. But move to the next slide. And what you'll see is how we look at what PG is. Well, PG is more than the price of the plain vanilla bond, but is less than the price of achieving governance with certainty, right? So that's kind of obvious. So PG is somewhere in the middle between the best case scenario and the worst case scenario because it's a probability. The next slide tells you how you might want to negotiate the coupon reduction, and that's what I'm going to talk about to end this discussion, really. So basically, if that is the pricing of the bond, you can say that increasing the gap between R1 and R2 is one way you increase the space of what can be shared. R1 is these are the discount factors. So if the governance criteria are meaningful, people think, wow, this is impressive. This is good. This is an improvement in the country. So the more meaningful you can make the criteria that you achieve, the more space you have to get a larger discount or create a larger discount and get more value to share. So the P2 goes up. If for the country's perspective, or for the bondholder perspective, let's say, if you reduce the distance between the coupon, so you say, well, I'm going to give you a 1 basis point reduction. That's not much because but the bondholder is well off because he's taking most of the increase in net present value. He's taking for himself. If he's stingy about the coupon reduction, you'd think that he can get a much better outcome for himself. The net present value increases, the price increases. Of course, but there's a countervailing problem. If the probability that the country will achieve the KPIs increases, then also the price of the governance linked bond increases. So actually, I'll go to the next slide. So the 3 drivers are increasing the gap between R2, that is the governance actions are meaningful, that you are reducing the gap between C1 and C2. This is the bondholder perspective. Coupon reduction is stingy, but increasing the probability that the government will do it. Now, this has a Laffer curve-like structure because as you become more stingy, that's the C2 goes towards C1, you keep the original coupon. Actually, you take alpha towards 0. The country has no real incentive to do anything or do this stuff because you're being stingy, you're not giving an incentive. Okay, and then if alpha goes towards 0, it doesn't matter what you do on however stingy you're on the coupon reduction, you still default to the state 1, which is the plain vanilla bond. So the Laffer curve, the idea of the Laffer curve is that if you tax people's income 0, you get 0. But if you tax them 100%, also you get 0 because they don't want to earn anything. So same problem. If you try to take too little from the country, then you get too little. But if you try to take too much, you also impact alpha and you get too little. So it creates a very nice incentive for bondholders to give a country kind of a reasonably generous offer that increases incentives to perform and also get something back in the same process, right? So it kind of balances out this incentive to be overly stingy or for the country to be overly greedy and say, we want the entire coupon back, and bondholders say no, okay? Just to finish off with a few more slides, this incentive alignment is really important. Triple incentive alignment we talk about. Positive incentive for better governance, which is good for everyone, which is good for the country, good for the world in general, to get governance improved all over, and good for financial markets. But very importantly, the country bondholder incentives are aligned. It's not like when you perform, you pay more. So the capacity to pay state contingent instruments are often, when you do well, you pay more. So this is kind of the incentives work in the opposite direction. But here the incentives are aligned. When you succeed, everybody benefits. It's a Pareto improving structure, not like the capacity to pay, which is certainly not Pareto improving. Somebody pays, somebody benefits. But it also, very importantly, aligns in-country political incentives, because now it creates political competition to say, hey, we can deliver these outcomes to you guys, to the country, and we can get a reduction in cost. So in terms of policy making, elections, you are setting in motion political competition, provided the KPIs are popular. So there are some kinds of governance measures that are not popular with people. You need to calibrate them to be popular. That visible, transparent, so people can observe them, see how the government's doing. They're trackable. So there has to be some public interest generated to drive the democratic incentives for the government to achieve them. It's then a win-win all around. Right? Society wins, government gets credit for it, the country gets some money back, the bondholders get a positive valuation. So, of course, just to tell you the story, this has gone out of the theory books into practice now, and people from White and Case and Rothschilds are here. This was the pitch we did to them, which you can go onto this link and download it, on why this should be introduced into Sri Lanka's debt restructuring. The next slide shows you actually the offer they made on Sri Lanka. So they've made an offer of a 50 basis point reduction of up to 1 billion on Sri Lanka's debt portfolio of about 12 billion that's being restructured, and on a governance linked on the KPIs. Right? So this is, I mean, you could say, well, we should do more, we should do less, whatever. But this is a real, practical, real world step forward on this instrument, and it'll be, if Sri Lanka agrees, it'll be the first time in the world that you've had a governance-linked state contingent instrument. Why did it work for Sri Lanka's case? I mean, two things were really important. I think because you're going to ask me the question, how do you decide the KPIs? Who are bondholders to tell a country how to improve its governance? That's sort of slightly crazy stuff. But actually what happened in Sri Lanka was we not only had an IMF program, but we had the first governance diagnostic done by the IMF for an Asian country, which means the governance KPIs were already agreed between the IMF and the government and already getting committed to in the IMF program. So bondholders don't have to come and introduce new things. All they've got to say is, look, you published these commitments, you're already on a program. And of course, this restructuring depends on you completing the IMF program in good faith. And so we can link the KPIs to stuff that's already on your IMF commitments and are meaningful and popular to people. And actually, the Sri Lankan civil society published its own governance diagnostic. They said, hey, we don't take the IMF as the defining authority. We are going to publish something of our own. And you will find that all the KPIs chosen overlap. That's in the Sri Lankan civil society governance diagnostics of this huge public support. Over 300 institutions signed up to that. And they're in the IMF governance diagnostic as well. So, and there's actually quite about 80% overlap between the two because civil society can actually influence the IMF as well. So this is really a win-win all around if it works out. And of course, this special case of having a governance diagnostic and IMF program with commitments that made it easy to get the KPIs out in a way that were non-controversial really helped make it practically possible. So let me stop there.
Thank you.
And take questions.
Thanks, Nishan and Raj. Super interesting, not least because, as you said, it's a real-world example. So you've convinced bondholders. Now you have to convince the issuer, and obviously the issuer is going to need to convince the OCC that it meets the comparability of treatment. So my question to you is, how does this meet COT? But before you answer that, we'll open it up to the floor for any other questions.
So all the easy questions I'll answer and the hard questions Raj will answer, right? That's how we're going to do this. Yeah. Okay, Theo is coming in here.
Hello, thanks for the presentation. I have two very quick questions. The first one is that the improvement in governance and the associated compression of the yield is going to be continuous while the coupon decrease would be discrete. How do you reconcile the two? And the second is about the link between this instrument and the IMF targets. If, as it seems to be the case in the current proposal, the targets are quite aligned or the same as the IMF targets. Why do you need the additional incentive on top of the risk of the IMF program going off track? And do you think it could expose the IMF to some kinds of pressures and their qualitative assessment becoming market sensitive?
My question would be, so let's say you're a bondholder, right? If these KPIs are met and we accept that the market yields would fall, then the yields would fall on all of the bonds, right? So as a bondholder, perhaps if you have a high conviction that those KPIs will be met, you'd rather be in the plain vanilla bonds because those keep the higher cash flows. So wouldn't you expect the GLB bond to trade at a discount or a higher yield than plain vanilla ones? Have you thought about that issue?
Can you tell me your name when you ask the question? Sorry, say your name again. Lucas.
Uli Waltz for SARS University of London. So you look at two stages where governance doesn't change, governance improves, but shouldn't you also look at a state where governance actually worsens? I mean, if governance is being measured and then it deteriorates, and then what happens to prices then?
Randy Henning again from American University. So this is fascinating, and I wish you well in this proposal, right? My questions were, you touched on this at the end, how are the criteria defined exactly, and how do we know whether they're being met, and who decides, right? And so you answered this question in reference to the fund, right, in the context of a program, partially. I'd be curious to know how you think this could work outside the context of a fund program, right? So does country have to be in a fund program in order to issue a governance-linked bond?
Should I take, is there more? Yeah. Oh, okay, one more, the last one up there then, and then we'll go for, yeah.
Thank you very much. David Gadmer from Julien Loki, prior at Lazard. So in my prior role, I might have actually said, why not tier bonds, but I'm not a decision maker on that regard anymore. But one comment first, I mean, you are redesigning a little bit, but what the market has known for a long time as inflation-linked bond. It's a bit different, but that was the same incentive mechanism. When you go down the inflations and everybody wins. And that's you stole my comment, so thank you very much. So that's the duality of the trading and the fact that a yield going down would go across the curve. But second, you have also to see the weight of your KPI, right? Because KPI is key here. So as you said, why bondholders would actually, give a view on what a country should do. If it's general KPIs, that might be. If it's a tax KPI, for example, there could be a lot of controversy into this because, and particularly in Sri Lanka, for one of the reasons of the crisis and what happened before COVID and the decision of the government to be very lax on tax collections. There might be a sort of debate here. And so how do you see in your question is, and how do you see in your work, the type of KPI that would be appropriate for such a structure compared to those that might be a bit more problematic? Thank you.
Thank you, David. So I think just starting with David's question, inflation linked can go either way because it reduces domestic debt burden more than it does external debt burden. So it's not clear how external debt will look at whether they get de-risked or not with higher inflation. So I think it is in that sense a much direct link. And I've already said the KPIs have to be things that are socially, politically popular. And there are two kinds of governance KPIs. This is the second kind. And if you want to get this moving, you've got to do that. To Randy's question, well, within an IMF program is how we know to do it right now. If we got to figure out a way outside of it, we've got to think about, how to get that agreement. But clearly there is a negotiation with bondholders and the country and the bondholders have thrown it up and said, here is some things we picked from your commitments. We can pick others that you want to propose. And certainly the country can propose stuff outside an IMF agreement. I think it's hard for bondholders to do so, just given the global dynamics. About governance worsening, I think I forgot who Uli asked that question. You could, but it's slightly different because the country doesn't want to come into that. And it's not the win-win in the same way that this is designed, right? So this has no downside. This has only an upside. It defaults to a plain vanilla bond. But if you did want something with a downside that punished countries on governance, that would look a little different and be trying to solve a slightly different problem. Yeah. If they had a positive expectation and were pricing in the positive expectation, of course, when it fails, it'll go down, but only because the positive expectation has been created prior, right? Otherwise, you have the standard expectation. Theo asked about, actually the most important question I didn't deal with was Lucas's question. Absolutely right, there is a free rider problem. I took off all my, I didn't feel I had the time to discuss it, but in reality, that's why it works well in a restructuring, because you can tell bondholders, well, you get a share of whatever you get in the governance-linked bond. If you gave them a choice and said, pick the governance-linked or plain vanilla in a context where substantial GLBs are called governance-linked GLBs are being issued, there's a free rider problem. Everybody wants a plain vanilla to benefit without paying the price. And so you've got to solve the free rider problem. That's something we discussed early, and which is again why it may be hard for a country to issue this on its own without a situation where you can issue all your other debt also in a way that is linked, right? So and either way, the plain vanilla bonds benefit. So the bond markets benefit because all the existing plain vanilla bonds also get a step up, and the free rider problem is certainly an important part of it. I'll come to your question last. Theo's question is on IMF targets. Why? So does the IMF come under a little bit of pressure that it knows that the markets will now actually also price evaluate what the IMF says? Well, the markets are always going to price evaluate whatever the IMF says, right? Because that is the nature of markets. If the country is not doing well and the IMF reviews say something, that's going to impact. It's a little more visible that they're doing that. That's not a bad thing. IMF has discussed this with us quite a lot. In terms of their own, what happens if they delay commitments, etc. So those are practical stuff that needs to get thought about. Theo, I forgot your first question. The second, I think you asked too, on the comparability of treatment. So we've been asked this question also, and what we are advising Paris Club and others to do, because actually it's the Paris Club side that's asking the question, or treasuries of various governments. We've said, look, treat it like a plain vanilla bond, because this has only a downside technically on the coupon to bondholders. The price upside is not something that Paris Club can want or not. That's a market thing. So if you treat it like a plain vanilla bond, you have no comparability of treatment challenge, because you don't have to put in the contingency side, because the contingency side kicks in for bondholders only when they can benefit on price. So that's a risk they're taking. As far as Paris Club is concerned, they should just say this is a plain vanilla bond, and that's how we do COT. That I think solves the problem and is also the most sensible way to do it. Thank you very much, Melissa.
Thank you.
Sorry. So just to say, if you asked hard questions about index eligibility, about how do you justify this under ESG, I would have given Raj to answer it, but the questions were luckily easy and I kept it short.
Thanks so much. Thanks to all the panelists. Thanks everyone for sticking around. Bye.
Please.